Most of the time, the financial world operates on a predictable rhythm. Investors look at corporate profits, analyze supply chains, and calculate value based on logic. Then a headline breaks. Global tensions escalate, or a conflict erupts. That rational framework often collapses as the public mindset shifts instantly from logic to emotion. Think of a crowded theater where someone suddenly smells smoke. Even without a fire, the movement itself creates panic. Others see the rush, assume there is danger, and the entire room reacts blindly. Financial markets behave the same way. During global shocks, fear travels faster than facts, leading to decisions based on raw adrenaline rather than economic reality. This reaction creates the wealth illusion. Rapid, violent price drops look like proof that the fundamental value of the entire world economy has broken. The physical reality on the ground tells a different story. Factories are still producing goods. Railroads are still moving freight. People are still buying groceries and using electricity. In the short term, the market acts as a voting machine. It tallies up daily headlines and mass anxiety, reflecting exactly how people feel rather than what a business actually produces. These crises often lead people to destroy their own wealth. They stop evaluating assets as owners and begin treating the market like a giant casino, where every headline requires a new bet. When fear takes over, the immediate reflex is to pull money from the working economy into perceived safe havens like precious metals or cryptocurrency. This diagram shows the price of an umbrella. On a sunny day, it's stable, but as a storm approaches, the price spikes. The umbrella itself is unchanged. That price spike is a premium for comfort, the cost of psychological safety during panic. This same logic applies to financial assets. Chasing a safe asset during a crisis often means buying the public attention surrounding it rather than its intrinsic value. While these fear-driven prices soar, investors often engage in a blind, indiscriminate sell-off of everyday companies that provide essential services. This shift moves a person from being an investor to a speculator. They no longer look at what an asset produces, but instead hope to find someone even more frightened to buy it from them later. Non-productive assets have a distinct limitation. They simply sit there. They do not hire employees, innovate, or generate new capital. Productive assets, like a well-run business, do the opposite. They sell essential products, earn profits, and reinvest those earnings to compound value over time. Even during a global crisis, people still wake up, brush pre-teeth, buy groceries, and use electricity. The real economy keeps moving because the demand for basic goods rarely disappears. History shows that industry adapts. Economic engines have expanded and retooled even through historic conflicts, continuing to produce goods and generate value despite the chaos of the world. Abandoning these wealth-producing engines for static assets out of fear often causes more long-term financial damage than the geopolitical event that sparked the panic. Experienced investors take a counterintuitive approach when the crowd speeds up. While everyone else reacts to the latest minute-by-minute headline, they slow down. They replace the immediate panic with a single deep question. What assets will still be valuable 20 years from today? This long-term framing reveals massive opportunity. It allows disciplined owners to acquire profitable businesses at steep discounts while the rest of the market is running away. True investors view these crashes as a temporary sale on the real functioning economy, rather than a threat to their survival. This shows wealth's quiet engine, compounding. A snowball rolling down a long hill grows slowly, but over time, its growth becomes exponential. Reacting to headlines destroys this advantage. When an investor panic sells, the snowball shatters, restarting from the top. Since forecasting every war or recession is impossible, many successful investors stop trying to time the news cycle. They rely instead on the history of productive assets, which have consistently survived shocks when left alone to grow. Despite endless historical crises, human progress moves forward. Technology advances, businesses adapt, and markets recover. True wealth is built by those who remain patient owners, allowing time to do the heavy lifting.